Hello everyone, my name's Elliot Gu, and I'm joining you today actually from the Money Show Master Symposium here in beautiful Sarasota, Florida, where I've been speaking at an energy-focused panel. It was a real pleasure actually to meet several of you in person here at the show following the panel discussion that I did earlier in the show. And I hope to meet more of you today. I'm walking around the exhibit hall and getting a chance to talk to some of you. And I wanted to talk about a key question I've been getting about the natural gas market. It's really some risks that are out there that I've been asked about a lot here at the show, but also from some of you via email, etc. And it's about, again, the natural gas market. And as many of you know, I've been quite bullish on natural gas, recommending a lot of natural gas focused stocks in the services I manage. And the main reasons are the growth in U.S. LNG exports. So these are exports out of the United States from terminals primarily on the Gulf Coast, on the U.S. Gulf Coast. And we have a number of new terminals that have been starting up this year and going into early next year. In fact, early next year, early 2026, or maybe even later on this month in December, we're seeing the Golden Pass terminal in Texas, which is managed by ExxonMobil and Qatar Gas. It's coming on stream, and this is a major new terminal that's already pulling gas out of the U.S. market. In addition to that, of course, we have the artificial intelligence, electricity growth demand story. Basically, artificial intelligence is very electricity intensive, and natural gas is really going to be the primary fuel used to generate the electricity to power these facilities, mainly because it is always available, unlike solar, wind, and other intermittent sources, and it's a lot faster to build a new natural gas facility than a new nuclear facility. So though I think nuclear has a longer term potential, it's not really an immediate solution. So a couple of the pushbacks I've been getting, the two most important I would say. The first is new capacity for pipelines coming out of the Permian Basin of West Texas and New Mexico. Now, most of you know the Permian Basin is primarily an oil-focused play. However, with the oil in the reservoir are large quantities of, significant quantities of natural gas, as well as natural gas liquids like ethane, propane, and butane. The natural gas, we call that associated natural gas. It's found naturally, really as a byproduct of, it's produced naturally really as a byproduct of oil production in the Permian. And because there's so much of it, because Permian production growth has been so high on the oil side, there's an awful lot of this associated gas there. And so gas prices in West Texas at the Waha hub are trading at a significant discount to NYMEX, or New York Mercantile Exchange, natural gas futures price for delivery at Henry Hub in Louisiana, near the Louisiana Gulf Coast. So one of the things that we're seeing is a number of companies building new pipeline capacity to move gas out of the Permian to the U.S. Gulf Coast, or increasingly also to Mexico. Some of that Mexican gas supply is actually serving LNG export terminals being built in Mexico. So one of the questions I get, well, when this new gas starts flowing out of the Permian, won't that depress U.S. natural gas prices? My view on that is no. We do have a major new pipeline. It's a 2.5 BCF, or 2.5 billion cubic foot a day natural gas pipeline that's moving from the Permian Basin to near Corpus Christi, Texas. And that's due to come on stream in the second half of 2026. We also saw the Matterhorn pipeline come online at the end of 2024. And what we saw when Matterhorn came online was a spike in Waha gas prices that lasted for a few weeks, followed by just prices collapsed again. And the reason being is that pipeline immediately filled up and there's still an excess amount of gas in West Texas and New Mexico. And I expect, and it was absorbed by the market, it was absorbed by growing demand. And I expect something similar over time with gas coming from the Permian Basin. First of all, as I said, a lot of it's actually going to Mexico, where it's being dedicated to Mexican LNG export terminals. And though some of it will almost certainly end up at U.S. LNG export terminals, as I said, there are a lot of new terminals coming on stream between now and 2030. A lot of them ramping up, in fact, right now and into early 2026. And so I think that's going to be more than enough new demand pull to absorb the additional supplies coming on out of West Texas. Also remember that these terminals or these pipelines aren't coming on stream in one go. It's going to be kind of phased in over time. So that gives a chance for the market to absorb that excess or that new supply. Also, of course, the AI demand story is kicking off in a big way in the next few years. We're seeing purpose-built facilities, basically natural gas-fired facilities, being built or converted from coal facilities to power just AI data centers. And so that's a story that's coming on stream a lot, especially in the 2027, 2028, 2029 timeframe. So that's one question I've been getting a lot. The other one I think is perhaps more important, and that is the fact that Qatar in the Middle East is developing one of their big fields, the North Field there, to produce LNG. And that's going to be coming on stream starting in 2027. So with all these new US liquefied natural gas terminals and these new natural gas export terminals come on stream in Qatar in the Middle East in 2027, 2028, there's going to be a lot of new supply of natural gas available for import from countries all over the world. So the question is, will there be some weakness of excess supply of natural gas, mainly in the second half of 2027 up through the first half of 2029, I would say would be the peak of this effect. Again, I think there's an awful lot of demand out there to absorb that extra supply. Certainly there could be some periods of oversupply, as we've seen really virtually almost every year in the natural gas market. But from a long-term perspective, there are a lot of new sources of demand. I would point out, for example, this year that European gas storage facilities are running much leaner. There's less gas in storage as we head into the peak demand winter months than there have been in the last couple of years. And this is a potential concern. If Europe gets a cold winter, as they're actually projected to do, due to the La Nina effect current in the Pacific Ocean, they could actually run short or run low on natural gas supplies, causing some spikes in European gas prices. I also think you have increased demand from China, increased demand from India, all these emerging markets over the world who are going to be more than happy to soak up these additional LNG supplies. But I think what's more important is some of the things we heard from the U.S. natural gas producers in their last quarterly earnings conference calls, which was for here in November primarily is when we got these calls, but it pertains to the third quarter of 2025. And what we've seen is actually a number of producers I follow signing long-term deals for natural gas supply starting around 2030 for 15 or 20-year supply deals. And so what's increasingly becoming apparent is that a lot of companies are looking to secure natural gas supply at premium prices, so at prices in excess of that NYMEX Henry Hub benchmark towards the end of this decade and early in the 2030s. And so that suggests some nervousness, if you will, among natural gas users or exporters about securing supply for that time frame. So they're thinking perhaps that after the market absorbs this new LNG supply from the US, but also from Qatar, that we're going to see reacceleration in a shortage of gas, LNG supply, into the 2030s. In particular, the Lake Charles methanol facility. Methanol is wood alcohol, it's also called. But it's basically can be synthesized from natural gas or coal. Coal, it's called brown methanol. We don't do that in the US. You have gray methanol, which is produced using natural gas. And you have what's called blue methanol, which is produced using natural gas, where the carbon dioxide created in this process to produce methanol is actually sequestered, is injected into subsurface storage. And the Lake Charles facility, methanol facility, is actually being designed as a blue ethanol or methanol facility. And actually, ExxonMobil's Denbury unit is handling the carbon capture and sequestration process. Now, why are they doing that? Well, some countries like Europe or regions like Europe have regulations on gray or the carbon dioxide content of methanol being imported, and so they can actually sell it for a premium pricing. That's why they're doing it. But methanol is a widely used chemical. It's used in certain plastics productions, and it's not LNG. LNG is just super cold methane or natural gas, but it's actually another way of exporting natural gas, which I don't think gets a lot of talk. But what we actually saw is a major natural gas producer here in the United States, a shale gas producer, actually signed a 15-year supply deal to supply natural gas to this Lake Charles methanol facility starting in 2030 through 2045, right, at a price premium to that NYMEX benchmark. So they're actually selling gas at higher prices than U.S. traded futures on an index basis starting in 2030. This is a sign of increased natural gas demand or the desire to lock down supply in that time period. We've also seen another major U.S. producer sign deals over the last 2 or 3 quarters for 6.5 million metric tons a year of natural gas supply on 15 and 20-year deals for LNG terminals on the U.S. Gulf Coast. The way these deals typically work is either a tolling arrangement or a sales purchase agreement, and they're effectively the same. A tolling agreement just means that the natural gas producer pays the LNG liquefaction plant operator to a fee to basically make the LNG that they then export. So they retain title to the gas through the whole process. They produce the gas, supply it to the LNG plant, pay a toll, and then they also still own the gas when it's loaded onto LNG tankers and sold into long-term contracts with companies that consume natural gas in places like Europe or Asia. Sales purchase agreement, technically, the gas producer is actually buying natural gas from the liquefaction plant operator, so they don't have title to it. But effectively, these are usually, in all these cases, are paired with gas supply agreements to that same terminal. So it's a little bit of a quirky way to organize it, but the reason it's done that way is for the liquefaction plant operator, it's easier to get financing for the project if they have these SPA contracts in place. So it's really kind of a legal financing thing. So we're actually seeing, again, these long-term supply contracts for liquefied natural gas into these Gulf Coast gas terminals for export abroad. So I actually think that we're actually seeing firming up of demand and some signs of potential scarcity of gas towards the end of the decade, not a glut of gas as some have been projecting. And I think that the overarching issue here is that a lot of the organizations that estimate long-term natural gas demand and long-term oil demand, particularly the International Energy Agency, are chronic short on demand. In other words, they're always saying demand is going to be lower than it actually turns out to be. In the IEA's case, I think a lot of it has to do with their over-enthusiasm for alternative energy, which has proven slower to actually displace demand for oil, natural gas, etc. I think we're into the 7th straight year, for example, where IEA has underestimated global oil demand significantly. So I really think that it's still a very bullish story for LNG and for natural gas production. And I think that neither of those issues is a long-term problem for the market. Right now, we saw natural gas storage here in the U.S. peak out under that psychologically important 4 trillion cubic feet level in mid-November. We've seen actually a pretty strong start to the winter heating season. The probabilities are that it will be an average to below average in terms of temperatures this winter because, again, of the La Nina, which affects both the U.S. weather, particularly in the upper Midwest and New England states, as well as European weather, making it colder than average over the long haul. So I think the natural gas market looks quite bullish. Our targets for a lot of these stocks are 20, 30, even 40% above the current price of the stock. A lot of these U.S. natural gas producers that are well placed in the key basins like the Marcellus Shale and the Haynesville Shale. Just based on a $4 million BTU flat natural gas price, $4 to $4.25. And we're actually above that in terms of the futures market pricing for what we call the 2026 next year calendar strip. The front month price of natural gas has been bumping up against $5 a million BTUs right now. So I think there's a lot of opportunity there. If you'd like to see specifics, check out, first of all, feel free to sign up here for Energy Bulletin using the box below on your screen, which is so we have a free component to the service where you get commentary from me and from my colleague Roger Conrad regarding energy markets on a frequent basis, usually once a week or so. And we also have a paid version of the service, which we're offering here for the month of December as a seasonal offer, a 60-day totally free trial. So in other words, sign up today and you won't be billed for the service for 60 days. We won't bill your credit card for the service for 60 full days. So you can give the service a try, full test drive. If you don't like it for any reason, just cancel within that first 60 days and you'll never be charged for the service. We have a model portfolio in Energy Bulletin, top 10 stocks portfolio, which is basically our top 10 energy-related stocks from all sectors of energy to buy right now. So if you'd like that, check that out. This is a great time. We are offering that holiday special for all new members, 60-day free trial. And we're also offering our lower price for longer-term subscribers. So I encourage you to give that a try. Thanks for listening. I hope you found this useful. And again, my name's Elliot Gu, and greetings from Sarasota.